wages have recorded their highest quarterly increase in history during the September quarter, increasing 1.3%. Joining me is business reporter Edward Boyd. Ed, the strongest quarterly wage growth since the ABS began recording data 26 years ago. This is, well, I guess on one element, good news because it could be tracking, close to inflation, so we're not going backwards. But what's it going to mean for inflation overall and rate rises?
Well, we've just seen in the last sort of 30 seconds or so, the stock market was up about 1.6%. It's come off a little bit. So investors starting to digest this higher than anticipated wage growth numbers that we've just recorded in the September quarter. So let's just get through a few charts because there's a few here just to explain the situation. Here's the wage price index. You can see Q3 up 1.3%. That is the highest in history since the ABS began recording this data 26 years ago. The annual rate up 4%, which is above expectations, and that is the highest annual rate for wages growth since March 2009. So quite a long period of time. Let's go to the next page here. And it'll be tracking, this is the quarter-on-quarter increases. And you can see that big acceleration in the September quarter. Remember, there was the Fair Work Commission ruling, which resulted in some significant pay rises for people in the private sector in particular. Let's go to the next page and we can look at the annual increases in wages. And you can see after languishing around the 1.5% mark during 2020, wage growth has been on a sharp rise and it's now up 4%. If we go to the next page, we can look at the comparison between private and public sector. You can see over the past 12 months, private sector wages have accelerated at a more rapid rate than the public sector, and that is due to the Fair Work Commission ruling, which came into place on the first day of the new quarter. So these wage growth numbers are important for our economy. Obviously, they're a good sign that people are getting paid more money. But the Reserve Bank, remember, they released their statement on monetary policy just last week. And in their forecast, they had wages growth expected to finish this year at an annual rate of 4%. Well, it's already reached 4% at the end of the September quarter. And you look around the economy and it appears wages growth is going to continue accelerating. So expect wages to lift even further by the end of the year, which will cause some headaches for the Reserve Bank and their economic modelling.
Yeah, so wages now level with inflation on a quarterly basis. I think I'm right in saying that, with inflation at 1.2, 1.3, depending on your preferred reading. Not keeping up annually, but as you alluded to there, if we've got a sort of pros and cons list for the RB on whether they increase rates, suddenly wage rises is firmly on the side of could contribute to more rate rises. Is that fair enough to say?
That's fair enough to say because, let's be honest, when people get a wage increase, they will spend that money. Right now, the Reserve Bank is hoping with the cash rate at its highest level since November 2011, they'll spend that money by putting a bit of extra aside on their mortgage each month. But I'm sure people who get a wage rise are going to want to splurge a little bit and treat themselves. And that obviously adds to the inflationary pressures in the economy. We've got a few more charts we can show you here, Tom. This one is just basically showing the wage price index in the September quarter, an annual rate compared to CPI. You can see that was 5.4. And now I've put them both on a line chart here, comparing them basically since around 2009. You can see inflation is the blue line, and it's obviously coming down quickly. And wages, you can see, is now accelerating. You can see there, wages are currently at their highest level since the beginning of that chart in 2009. The Reserve Bank, in their modelling, they believe wages will increase above inflation in June next year. So you're looking at another 6 to 9 months before we see wages above the level of inflation. At least that's what their most recent modelling showed.
Yeah, which is good in isolation, but what does it do for the longer term outlook for rates? Ed, overall is going to be the question, isn't it? So it's kind of, we're finally getting a situation where wages might tick above inflation, but it could mean it's great if you don't have a home loan. If you do, or even if you're renting, because it means rents probably go up, then it could be a sort of two-edged sword here.
It could. Basically what it means is rates, unfortunately, will probably need to stay higher for longer than anticipated. I think that might be one of the reasons why the market's dipped a bit today. We know rents, the governor of the Reserve Bank talked about that, saying she's expecting rents to peak in about 6 months from now. So rent pressures are going to continue for a while. It's going to add to inflation. It's unfortunately going to keep rates high.